Good morning and welcome to the Killik & Co podcast for Friday, the 17th of April. I'm Patrick Gordon, standing in for Mike Pate today. Last week was quite a busy week for macroeconomic data, and on the whole, probably disappointing relative to what was expected. Was this due to temporary factors such as the weather in the US, or is it going to prove to be something which is slightly more enduring? We'll take a look at some of the indicators that came out last week. Given now that a lot of the policymakers have less forward guidance language in their statements, there is a lot more attention on each individual macroeconomic data point that is coming out at the moment. And so they are being closely scrutinized for any changes in policy or potential clues as to the timing of the changes in the policy. We had the ECB meeting this last week. They have reaffirmed their commitment to their quantitative easing program, and inflation data also was a big feature this last week. And we had data out of the Eurozone today and also out of the UK this week, and we've got the US data out later on this afternoon. And of course, Q1 reporting season has also kicked off. We start with some of the macroeconomic data out last week. We look at China. China GDP data came out showing that growth in the first quarter was 7% year on year. This was in line with expectations, but as we can see from the downward trend that we're seeing there, it was lower than the 7.3% growth that we saw in Q4. And also, in fact, it's the lowest growth rate we've seen in China for the last 6 years. If we look at some of the underlying activity indicators, they're also quite weak. Here we're looking at industrial production year on year. It showed that it slowed to 5.6% in March. So this was down from 6.8% year on year for the first 2 months of the year, and also was below the 7% that was forecast, and really serves to illustrate that some of the challenges that China is facing as it does look to transition its economy from an investment-based economy to a more consumption-led economy. So how's that featuring or filtering through into the equity markets? Well, it's not really. As we can see here, we've got a very strong performance in the Shanghai Composite Index. This is due to the expectation that with the slowing economy, we are likely to see some more policy action, but also a lot of domestic demand for equities in China. The way we see probably the best way of playing to the China's longer-term growth story is through some active fund managers. Our fund research team does have some recommendations in this space if you want to contact your broker for those. Moving on to the US, again, on the whole, US data has continued to be slightly weaker than expected, partly due to the weather, as we mentioned previously. I mean, we can see here that there has been a rebound up from the weak performance in February. So it does add to the argument that part of February's weak performance was due to the weather. However, the rebound wasn't as strong as had been anticipated, and so it did miss the expectations. This does suggest that some of the extra disposable income that consumers have as a result of low energy costs is probably being saved rather than spent. The US dollar, some of the weaker data points out of the US recently has taken some of the gloss off the US dollar. You can see this is the US dollar index, and you can see just recently there has a little bit of a stabilization or a slight downward dip there. Nevertheless, despite the weak data we've seen recently, the expectation is still that the Fed will be the first of the major central banks to raise interest rates. And the divergence in the policy of the Fed relative to some of the more accommodative central banks out there, we believe will continue to underpin the dollar over the medium to longer term. And with Q1 reporting season in swing at the moment, what we'll be looking at is some of the outlook statements and also the reports themselves to see what impact the dollar strength is having, particularly on the major multinational companies reporting. Moving to the UK, Inflation in general this week, as I mentioned, is quite a big feature, or has been a big feature. The UK CPI data showed that the inflation remained at a record low of close to 0%, in fact slightly below 0% if we go to 2 decimal places. In the Eurozone today we had some data out which confirmed that year on year it was just slightly negative, 0.1%, and then we've got US data later on this afternoon expected to be flat. Clearly a key metric for central banks at the moment is inflation and inflation expectations, and we do expect that if we do see a rise in wage growth, that will be something which may contribute to central bank policymakers reassessing their view on the interest rate environment and looking to address inflation considerations which could come through. We could see inflation picking up as we see wage growth come through. We mentioned that the ECB did have their meeting this week. The quantitative easing program and the problems in Greece are having quite a material impact on bond yields at the moment. This is the generic 10-year Bund, really is closing on the zero level at 0.07% this morning. So the combination of both the concerns over Greece and QE having a material impact. Despite this, though, I mean, the ECB has reaffirmed commitment to the QE program, so dispelling any suggestions that they may look to taper the program. Events in Greece, as I mentioned, also obviously weighing on the markets at the moment. The 3-year Greek bond yield is now at 26% today, 10-year yield at 12.6%. We expect it to continue to dominate headlines over the coming week or so. So next week, Greece obviously is going to remain in focus. We've also got the Bank of England minutes out on Wednesday and some manufacturing data out on Thursday, UK retail sales and durable goods. So those are the macroeconomic forecasts we'll be looking at, or data points we'll be looking at next week. As I mentioned, we are in Q1 reporting season at the moment. A lot of the banks have reported. Wells Fargo is one of the Killik & Co stocks which reported this week. It showed strong balance sheet growth. It continues to be strong. Loans up 7%, deposits up 9%. But this isn't quite feeding through into the income statement at the moment, given the low interest rate margins. But that does mean that it is well positioned, should interest rates start to rise, to benefit from that rising trend. And also as mortgage originations pick up, we do expect to see Wells Fargo benefit from that trend. Looking ahead to next week, a number of Killik & Co stocks are reporting. We've got GKN, BHP Billiton in the mining sector, Verizon Communications and Yum Brands. We've got Tesco be quite closely looked at given the problems that they've had recently. Boeing, EMC Corp, but also some other major bellwethers, Coca-Cola, McDonald's, AT&T amongst them, reporting in the week ahead. And on a Thursday, Microsoft, Union Pacific and Amazon, Google and PepsiCo amongst the Killik & Co stocks that we cover, and Whirlpool as well on Friday. Just touching briefly on one of those stocks, GKN results. The equity research team like this stock because of the exposure that it does provide to the automotive and aerospace markets. The global auto production expected to grow at 3%, compound annual growth rate to 2020, and GKN is expected to grow above this rate. And on a valuation of 12.5 times 2015 forecast earnings, we believe it is attractively valued relative to its peers. That's all from me this week. Have a good weekend. Thank you.